If you own an LLC, there is a good chance you are paying yourself the wrong way, and it could be costing you thousands of dollars a year. I'm Misha Vabran. I'm a CPA, and I've sat across the table from business owners who built a great business, brought in some real money, and still had no idea how much they were allowed to pay themselves or how to do it the right way. And some of those people were taking money out whenever they felt like it with no real plan. And some of them were just too scared to take out any money at all. And because of that, they did not understand the tax rules. And some of them were leaving thousands of dollars on the table every single year simply because they did not understand or no one showed them how the system actually works. So in this video, I'm going to be breaking down and walking through step by step exactly how to be able to pay yourself from your LLC in plain English language, no confusing jargon, no guessing. And by the end of this video, you're going to know exactly how much you can pay yourself, how to do it the legal way, and how to be able to keep more of your own money in your pocket instead of handing it over to the IRS by accident, which is what so many business owners do. So let's get into it. All right, let's talk about how your LLC is taxed, because that's going to change everything for you, right? So here's the first thing that you need to understand, and it's probably the single most important idea in this entire video. An LLC is not one single tax setup, right? The letters LLC only describe your legal structure, and they do not tell the IRS how to be able to tax you. And that means two business owners can both have an LLC, pay themselves completely different, completely legally, because the IRS is taking and taxing their business differently behind the scenes. So here are three common setups you need to know. All right, number one is going to be a single member LLC with no special election filed. All right, so the IRS treats this like a sole proprietorship. Number two is going to be a multi-member LLC with no special election filed. The IRS treats this like a partnership. Number three is going to be an LLC that files paperwork to elect S-Corporation tax treatment. And this changes the rules completely. And it is where a lot of the tax saving strategy lives. All right, so let's go through each one in detail with real numbers so you can see exactly how the money moves. All right, so number one, let's talk about a single member LLC, which is the owner's draw method. All right, so if you are the only owner of your LLC and you have not filed any special tax election, the IRS calls this a disregarded entity. So that means for tax purposes, your business profit and your personal taxes are treated as one and the same thing. The business does not file its own separate tax return. Instead, the profit flows straight onto your personal tax return on Form Schedule C. So how do you pay yourself? You use what is called an owner's draw. All right, so an owner's draw is simple. You move money from your business bank account to your personal bank account, and that's it. There is no paycheck that you have to write. There is no payroll that you have to run. There is no taxes withheld when you make that transfer. So let's go through an example so this is like crystal clear for you so you can understand exactly how this works, right? So say your LLC brings in $150,000 a year in revenue. All right, after paying for supplies, software, marketing, other business expenses, your profit is $80,000. All right, so you decide to draw out $50,000 over the course of the year to pay for your personal bills, and you could leave the remaining $30,000 sitting in your business bank account, maybe to buy equipment next year or just as a cushion. So here is the part that surprises almost everyone. You do not need to just pay taxes on that $50,000 that you drew out, okay? You pay tax on the full $80,000 of profit, even the $30,000 you left in the business. Why? All right. So a lot of people are confused by this. It's because the IRS does not care whether you physically moved money to your personal account. It only cares about how much profit you made in your business. So the draw itself is not a taxable event. It's just accessing money that you already were going to be taxed on as profit. So whether you took it out or not. So this trips up a lot of business owners constantly, and it's probably one of the most asked questions I get. And they think, okay, I only paid myself $50,000. So that is all the money that I owe on taxes. And then when tax season comes and they owe $80,000 on taxes, and they're caught off guard. And so you don't want to allow that to catch you off guard, right? That's not going to be you. So one important detail to keep in mind, all right? An owner's draw is also not a deductible business expense, all right? So it's not going to lower your profit. It is simply a transfer you already own from one pocket to another, and that's exactly how that works. All right, so let's talk about the next one that you need to understand, which is a multi-member LLC. All right, so if your LLC has 2 or more owners, you do not have and you have not selected an S-Corp or a C-Corp status, the IRS taxes your business like a partnership, right? So each owner called a member reports their share of the business profit on their personal tax return based on the ownership percentage or whatever split is written into your operating agreement. So just like a single member LLC, each partner can take a draw. So same rules apply. No payroll, no withholding, and the draw itself is not what gets taxed, all right? So the profit allocated to you is what gets taxed. Now, some multi-member LLCs also use something called a guaranteed payment, all right? And this is a fixed payment made to a partner for services that they provided to the business. So regardless of whether the business made a profit that period. So I want you to think about of it like a salary substitute for partners, right? But it is taxed differently than a real paycheck. So here's an example. So say 2 partners are running a consulting LLC together. One partner handles most of the client work and gets a guaranteed payment of $60,000 a year for that effort before profits are split. So whatever is left over that guaranteed payment gets divided between both partners according to their ownership split. So guaranteed payments are still subject to self-employment tax, and they still are not run through a formal payroll system the way a W-2 paycheck is. So the partner just receives the payment and reports it on their personal return. So like single member LLCs, multi-member LLC partners are responsible for sending in their own quarterly estimated tax payments through the year, since nobody is withholding taxes for them automatically. All right, let's talk about the third way to be able to pay yourself, which is through an S-Corp election. All right, so now we get to the strategy that genuinely saved a profitable small business owner real money every single year, right? So your LLC can file a form with the IRS called Form 2553, and asking to be taxed as an S corporation. So your legal structure stays an LLC. Nothing changes with your state paperwork. Only the way the IRS taxes you is going to be impacted by this. So once this election is approved, the rules are going to shift in a big way for your business. So now you're going to be required to be able to pay yourself a salary through real payroll. So that means a real paycheck, a W-2 at the end of the year, and tax withholding just like an employee at any company. But here's the part that creates savings. All right. On top of your salary, you could also pay yourself a second type of payment, and that is called a distribution. So a distribution is extra profit paid out to you as the owner, separate from your paycheck. And here is the key that makes the whole strategy work. On your salary is going to be subject to payroll tax. So your distribution is not subject to payroll tax at all. So let's walk through the math slowly, because this is the heart of the entire video. So say you're an LLC and now you're taxed as an S-Corp and you earn $150,000 in profit for the year. You, as the owner, decide your reasonable salary for the work you do is $70,000 a year. That $70,000 salary runs through payroll. So it gets hit with a 15.3% combined payroll tax split between you and your business. So the remaining $80,000 of profit gets paid to you as a distribution. So that $80,000 still gets taxed as regular income on your personal tax return. So you are not avoiding income tax on it, but it completely skips that 15.3% payroll tax. So let's compare that to what would happen if this same LLC was just considered a sole proprietorship with no S-Corp election, all right? So in that case, the entire $150,000 of profit would be subject to self-employment tax, which is that same 15.3%. So by splitting the income into a $70,000 salary and an $80,000 distribution, you only pay 15.3% on that $70,000 instead of on the full $150,000. So roughly speaking, that split can save a profitable business owner somewhere in the range of $10,000 to $12,000 a year in payroll tax, compared to self-employment tax on the entire amount. So that's going to be real money, and that is the entire reason profitable LLC owners look into an S-Corp election in the first place. All right, so let's talk more about this 15.3%. All right, so I'm going to slow it down a little bit and break apart that 15.3% number, because you're going to hear that constantly. And I want you to actually understand what it's made of and what it means. All right, so it is made up of two separate pieces. All right, the first piece is going to be 12.4%, and that goes towards Social Security. All right, the second piece is 2.9%, and that goes towards Medicare. All right, so you add those two together, and now you get 15.3%. Here is the important thing. The Social Security piece, that 12.4%, only applies up to a certain amount of income each year. So in 2026, that cap is $184,500. All right, so once your salary or your self-employment income crosses that number, you stop paying self-employment or stop paying a Social Security portion on anything above it for the rest of the year. So the Medicare piece, that 2.9%, has no cap at all. So it applies to every single dollar you earn, no matter how high your income climbs. And if you are a high earner, there is one more layer. All right, so once your income passes $200,000 a year as a single filer, an additional 0.9% of Medicare surtax kicks in on the amount above that threshold. So very high earners are actually paying more than 15.3% on their top dollars. So this is exactly why the salary versus distribution split matters so much for an S corporation. So every dollar you legitimately move from salary into distribution is a dollar that skips the entire 15.3% calculation while still being taxed as a ordinary income. All right, so the reasonable salary rules. So I need you to listen to this closely, because this part here, this is where business owners get themselves into some real trouble. So you want to make sure you're paying attention, right? So you might be thinking, if distributions skip payroll tax, why not just pay myself a tiny salary, right? Like $10,000, and take the rest as a giant distribution. Wouldn't that save me even more money? And the IRS saw that question coming decades ago, all right? And they built a rule specifically to be able to stop it. And that rule is called reasonable compensation, all right? It requires S-Corp owners who work in business to pay themselves a salary that reasonably reflects what someone in that role with that experience would normally get paid. So how does the IRS decide what counts as reasonable? All right, so they look at several factors, like your training and experience, the time and effort you actually put into running the business, what comparable businesses in your industry pay someone doing the type of job that you're doing or providing the type of service that you're providing, your business's gross receipts and profit, and what you have paid yourself in the past years. All right, so if you pay yourself $10,000 in salary while taking $200,000 in distributions, that is going to be an enormous red flag. So if the IRS audits your business and decides your salary was unreasonably low, they can actually reclassify a chunk of your distributions as salary after the fact. So that means back payroll taxes, penalties, interest, all at once. And this is exactly the kind of decision where working with a CPA pays for itself. So setting the right salary number, one that is defensible and reasonable for your specific role and industry, protects you from the audit risk while still letting you benefit from the distribution strategy the legal way. So let's talk about some common mistakes that I see with LLC owners when it comes to being able to pay yourself. So I'm going to walk through a couple of these that I see over and over again to help you avoid them. So number one is treating that business bank account like a personal piggy bank, right? With no record of what was a draw and what was a business expense and what was a loan to the business. All right. So this makes your books a mess and makes tax time painful. All right. Let's talk about mistake number two, not setting aside money for taxes throughout the year, then being shocked by a massive tax bill in April. Number three, electing S-Corp status without running the numbers first. All right, so the S-Corp election adds real cost to your business, like payroll processing and a separate tax return. So if your profit is not high enough yet, then those added costs can actually outweigh the payroll tax savings that you would have received by doing this. All right, mistake number four, paying yourself an unreasonably low salary after electing S-Corp status just to dodge payroll taxes without understanding the audit risk that it creates. Number five, mixing your personal and your business expenses into the same account, right? This blurs the line between what is actually a draw and what is a real business expense. And it is one of the fastest ways to create problems if you are ever audited in the future. All right, so those are going to be some things that you need to keep in mind. One more piece that trips up a lot of LLC owners: if you are taking draws, nobody is withholding taxes on your behalf the way an employer would if you were a regular employee. So that means you are usually responsible for sending the IRS quarterly estimated tax payments throughout the year on your own. So if you underpay, the IRS charges a penalty that builds up daily. So to stay safe, you generally need to pay either 90% of what you actually owe for the current year or 100% of what you owed from the previous year. So if your income was higher last year, specifically if your adjusted gross income was above $150,000, that second safe harbor number rises to 110% of last year's tax. So a simple rule of thumb that works well for small business owners is to set aside 25 to 30% of your profit for taxes in a completely separate savings account. That way you don't touch it for anything else. And you want to treat that money as if it already belongs to the IRS, because in a sense it actually does. Okay, so when it comes to this, I'm going to break down a couple of more frequently asked questions to be able to really make sure that you have everything that you need to know on this topic going forward, right? So first question I typically get is, can I just write myself a check whenever I want to? So if you are a sole proprietor or partnership taking draws, yes, within reason. There's no law saying that you can only draw money on certain days. Just remember, you still owe tax on that full profit and not just on what you draw. Another commonly asked question is, what if I had a bad month and I can't pay myself? That is completely fine for draws. You're not required to have a fixed amount of draws. This is actually one advantage of the draw system over an S-Corp salary, which is expected to be consistent. Next question I get is, do I need a separate business bank account? And the answer is yes, absolutely yes. Even though the law technically allows a single member LLC to use one account in some cases, but mixing personal and business is probably one of the biggest red flags in an audit, and it makes your own bookkeeping a nightmare. So you want to make sure that you keep them separate from day one. All right. And next is, how do I know if I am profitable through and profitable enough to be able to have an S-Corp election to make sense, right? So as a general guideline, many CPAs start looking seriously at an S-Corporation election once the business consistently profiting more than $80,000 a year after expenses. It could even be lower than that, even $50,000 could be worth having a conversation. But below that number, the added administrative cost is often not worth the payroll tax savings. But every situation is going to be different. And this is a conversation to have with your CPA, right? Not a decision to make just alone from a video, right? And understand that every business is different. Your best setup is going to depend on your profit, your state, your industry, your personal financial goals. So the numbers in this video, like the $184,500 Social Security cap, that reflects 2026 numbers, right? Those numbers are adjusted by the IRS almost every single year, so you always want to make sure you check the current year's numbers before making decisions, all right? So this video is for education. So before you make a big decision like electing an S corporation status or setting up your salary, make sure you go ahead and talk to your CPA, know your full financial picture. This is what we do every single day, and it is a conversation worth having. All right. So couple of steps that you need to take with this. Step number one, make sure you figure out exactly how your LLC is currently taxed. Sole proprietorship, partnership, or S corporation. Number two, you want to calculate your actual profit for the year, not just the amount you personally have drawn out. Step number three, if you are consistently profiting more than $80,000 a year, make sure you go ahead and sit down with a CPA and run the actual numbers on your S-Corp election, all right? If you elect S-Corp status, set up payroll immediately. You want to choose a salary number you could defend to the IRS if they ask you about it. Step number five, you want to open up a separate savings account today. You want to start setting aside 25 to 30% of your profit for taxes. And that is what you're going to be able to do to make sure you are successful with paying yourself through the business. All right. So in the next video, I'm actually going to be breaking down a number and a change that affects almost every small business owner that pays contractors. The IRS just raised the 1099 threshold, and most business owners have no idea about it. So make sure you go ahead and watch this next one, and I'll see you there. Take care.